Welcome to Siri Fast 5, where we detail hot topics in commercial real estate in 5 minutes or less. I'm Carly Iacono, and tonight we are taking a much needed break from the ongoing coverage of the COVID-19 shutdown to talk about a part of the market that is doing really well right now and will continue to when this is long behind us. And I am talking about convenience. Convenience is an incredibly stable, long-term play for net lease, and I'm going to tell you why. The first is market penetration. There are over 153,000 convenience stores in the United States alone. And just to put that in perspective, that is more than all of the grocery stores, discount stores, and drug stores combined. 93% of the US population lives less than 10 minutes from a convenience store. So in a time when getting goods to consumers quickly and meeting your consumer in their market is paramount, they're set up, they're already doing it, and they're extremely well positioned. The next thing to look at is the adaptability. Most convenience stores are 2,500 to 5,000 square feet, very manageable footprint. So they can take this limited amount of space, limited overhead, and quickly adapt their product mix to meet current demand. And this is playing out beautifully right now as convenience stores are offering more toilet paper, more milk, more bread, more of those basics that consumers can't get elsewhere. And that's really turning into increased profitability. Now, when this pandemic is beside us or beyond us, they can then go back to offering the standard product mix and trying some new things, whatever it is they want to do, because that space is so flexible for them. The next thing to think about, it is an incredibly employee light business. So if we have a payroll heavy business, obviously that's going to impact the bottom line as minimum wages keep increasing. Having less employees also leads to just overall operational consistency. So I like that this is a model that does not require a lot of employees. And in fact, some are even trying cashierless stores, which we'll talk about in a minute. So the adaptability, the manageability of the amount of square footage, the fact that it's payroll light, and the fact that it's well positioned in the market as a space in net lease, all makes it something that I would watch. Now, there are two main tenants that you need to be thinking about, really two market leaders. The first is 7-Eleven. 7-Eleven is an investment grade company, exceptionally strong credit. Their stores are typically 2,500 to 3,500 square feet. They both franchise and run corporate stores. Their lease structure on new builds right now looks to be 15 years max on a triple net basis, but do note that a lot of their leases have roof and structural responsibility on the landlord. So if you're looking for something that's absolute net, purely passive with no involvement, you want to be aware that some of their leases do put that back on the landlord. Not tremendous amount of involvement, but something to still pay attention to. Now, on a business model perspective, 7-Eleven is doing some things that are really interesting. Their first is called the 7 Now delivery system. So they're rolling this out in a lot of their markets. Hopefully it will be everywhere soon. And what this does is allow ordering online for a mixed bag of goods, not just food items, delivered to the consumer in less than 30 minutes. So if they can pull this off, I think they are really a contender for Amazon in terms of their delivery model, speed, and I think they'll continue to gain market share. The next thing that they're doing is an increased product mix. They just opened a new flagship store in Manhattan, which is very nicely laid out, and they're beta testing things like organic blueberry lavender Slurpees. Now, I'm not a huge Slurpee person, but I might try an organic blueberry lavender Slurpee. So I think they're doing it right. They're trying to draw in a new consumer base with some of these more creative products, an updated store model, and a very streamlined new look. The last thing they're trying that is very interesting is cashierless technology. So they rolled this out in some of their Texas stores. I believe it went well. I hope we see more of it. If they can pull this off, it would be a direct competitor to Amazon's Go's cashierless convenience store. So all those things make 7-Eleven at the forefront of the convenience space and definitely something to consider from an investment perspective. Now, their direct competitor, Wawa, is a bit different. They are a private company, very successful, strong financials from what we can see from the outside. Their stores are a bit larger, 2,500 to 5,000 square feet, and they are focused on food, really more than anything else. So that fresh made to order, they have a lot of healthier pickup options. Their stores are very spacious. It's a clean, inviting environment, and they put a lot into their branding. They run something called Hoagie Fest every summer that almost has a cult-like following, if you will. They get very into the different sandwich options and the paraphernalia, etc. So they try to get the consumer excited about the Wawa experience. They are also invested in electric technology, electric charging technology. So if you happen to think that gas is going by the wayside, which I hope it does, I in fact drive an electric car, then this is something you might really want to think about aligning with. Wawa has electric chargers at a lot of their stations, and that is drawing in new consumers, can speak for myself on that, who might otherwise not have been. And while they're there charging, they are also going into the convenience store, which is boosting sales. So they're doing a lot of things different but right as well. They don't have the in-house delivery system like 7-Eleven has. They're still partnering with DoorDash and Grubhub, etc. So I think that's something they need to invest in. But overall, very strong company, great product mix, really nice stores. They've put a lot of money into renovating them recently as well. And on average, they'll spend about $1 million per store when they're doing a full renovation. So that's a lot of money for that amount of square footage. And they're coming out absolutely beautiful. Really, really nice new prototypes. Wawa and 7-Eleven, two incredibly strong tenants to watch. They're killing it right now. Expect they will moving forward. If this is something you'd like to explore further, or you have one that you're ready to sell, feel free to give me a call. Happy to talk through this part of the market with you in more detail. That was CRE Fast 5. I'm Carly Iacono. Look forward to seeing you again soon.